a $200 gold move in gold is of no interest to me. I couldn't care less. I own gold not because I think it's going to go through 2000, but because I'm afraid it's going to go through 8 or 9,000. And I feel the same about the price action that we've seen in silver. I don't think we're seeing a silver breakout yet. In my experience, precious metals bull markets are led by gold. Then the money moves to the gold stocks. And then when that price momentum attracts the generalist investors, which it only has for the last 13 or 14 weeks, eventually leadership goes to silver.
RickRule of Rule Investment Media emphasizes that the real story isn't whether gold is trading at $2,000 or silver at 37, it's about long-term wealth preservation in the face of a steadily eroding US dollar. For Rule, these day-to-day price movements are just noise. His conviction lies in the trajectory of monetary policy and the dollar's declining purchasing power, which he believes could eventually push gold to $8,000 to $9,000. Since President Trump implemented sweeping tariffs that disrupted global trade flows, the dollar has fallen to multi-year lows, an unusual move during periods of geopolitical stress. Historically, such tensions tend to strengthen the greenback. But this time, as former Morgan Stanley banker David Roche notes, the dollar is underperforming as global capital reallocates away from U.S. assets. Roche highlights the structural shifts in currency dynamics that are challenging traditional assumptions about the dollar's strength. Even U.S. Treasury Secretary Scott Bessent was caught off guard. In a private email, he admitted that while tariffs are generally inflationary and expected to support the dollar, the current environment is proving more complex and volatile than predicted. Rule draws comparisons to the 1970s, when the dollar lost 75% of its purchasing power and gold rose 30-fold. While he isn't forecasting another 30x increase, he sees a similar dynamic unfolding, a significant revaluation of gold in response to the dollar's long-term devaluation. If the dollar loses another 75% over the coming decade, gold, he argues, will rise accordingly. Amid this long-term repositioning, central banks continue to move aggressively. The People's Bank of China has reported 16.8 tons of gold purchases so far in 2025, reinforcing the narrative that global monetary authorities are hedging against the weakening role of the dollar in the international system. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
As I recall, we talked about the fact that the precious metals prices had to go higher, and that the lead higher in precious metals prices, if this market followed other markets, would mean that leadership would eventually change from the bullion to the stock, right, and then that gold bull markets are led by gold, but eventually transition to silver. So right, and right. All good. Now, in terms of what we're seeing in the last week, from my viewpoint, this is all staccato. This is all noise. In a different prior interview, when you and I were together, you were mentioning some of your listeners, probably younger listeners, concern about would the gold price ever get through 2000? I don't know if you remember this. And I remember saying to you, you know, Chris, a $200 gold move in gold is of no interest to me. I couldn't care less. I own gold not because I think it's going to go through 2000, but because I'm afraid it's going to go through 8 or 9,000. And I feel the same about the price action that we've seen in silver. I don't think we're seeing a silver breakout yet. In my experience, precious metals bull markets are led by gold. Then the money moves to the gold stocks. And then when that price momentum attracts the generalist investors, which it only has for the last 13 or 14 weeks, eventually leadership goes to silver. When leadership goes to silver, you're not going to need some old fat bald guy, RickRule, to tell you that leadership has transitioned. I've watched 3 silver bull markets in my life, and they are nothing if not dramatic. You won't be talking about a move from 34 to 36 or 7 and back. You're not going to be talking about dollar moves. You're going to be talking about lock limit up. Let's get that one straight. Yeah, people are interested in dollar moves. They're interested in intraday moving averages and stuff like that, I think, to amuse themselves. I'm interested in quantum moves, which require more time. I think for the balance of my life that the US dollar will be the world's reserve currency. For the record, I'm a very healthy 72-year-old, but I think that U.S. hegemony will decline, which is to say that the dollar's current market share in global transactions will fall from the high 70s to some lower number. What I do believe is that the U.S. dollar as a measure of liquidity will outperform the U.S. Treasury as a store of value. I believe in an absolute sense that, not relative to other fiat currencies, but in an absolute sense, that the US dollar will lose something like 75% of its absolute purchasing power in the next 10 years. We saw this in the decade of the 70s. And I think I can back up arithmetically why that's much more likely to happen. The consequence of that is that although gold will not replace the US dollar, either completely as a store of value and as a medium of exchange, that the increase in the gold price should be at least concomitant or proportional to the decrease in the purchasing power of the US dollar. For gold bugs to be happy, you don't need the obliteration of the US dollar, and you're not going to get it. Did you know in the most recent estimate by Morgan Chase, the market share of gold and precious metal securities relative to other asset classes was only 0.5%. The 4-decade mean was 2%. And according to Morgan Chase, they admit to not having statistics going back that far, but they estimate in 1981, the sort of nadir of the gold bull market, that the market share of precious metals and precious metals related securities relative to other asset classes was between 6 and 8%. I'm not suggesting that we take out our old high market share, but I'm suggesting that demand reverts to mean. Imagine what happens, given that price movements take place in just part of the value chain, if we increase demand for precious metals fourfold. That's what I think is going to happen. I'm talking about it in the price of goods and services.
Okay.
The U.S. government, has managed to confuse the U.S. taxpayer and the U.S. consumer and the U.S. voter by getting you to focus on something called the CPI, colloquially known as the CP lie. If you believe in that, you believe that U.S. inflation, I would define inflation as the deterioration in the purchasing power of the dollar, is progressing along at a nice tepid 2.5%. The problem is that this defies common sense and arithmetic. First of all, Chris, I don't know if you know this, but the CPI doesn't include tax. The idea that there's a cost of living that doesn't include the largest component of one's cost of living is fallacious to begin with. But let's get away from that. Take yourself back to 2020, or have your readers take themselves back to 2020, and look at the period 2020 to 2025. What's happened to energy prices? What's happened to the gasoline price? What's happened to health insurance and health care? What's happened to mortgage interests? What's happened to housing prices? What's happened to rent? The idea that your groceries up 60%. The idea that the purchasing power of your US dollars has declined at 2.5% compounded is hilarious unless you happen to be living on a fixed income, in which case it's treacherous. That's really what I'm talking about. And I'm talking about one more thing, Chris. Gold does well when people are concerned about the maintenance of their purchasing power in US dollars. So think about this. If you are invested in the world's premier savings instrument, the best of the best, the one that everything else is measured against, that's the US 10-year Treasury. If you're getting paid 4.5 in a currency that's declining by 2.5% a year, you're making a 200 basis point or 2% real yield. Not all bad for a riskless asset. If by contrast, you're getting paid 4.5 in a currency where the purchasing power is declining by 7.5%, you're actually losing 3% of your purchasing power every year for 10 years. At the end of that 10-year period, the U.S. government gives you back 60% of the purchasing power that you started out with before you made the investment. A guaranteed loss. That's why gold is doing well. And that's why U.S. dollar savers need to understand the juxtaposition between nominal yields and the declining purchasing power of the dollar. It's critical. I've been through this before, Chris. You're too young. But in the decade of the 70s, the purchasing power of the U.S. dollar declined by 75%. $1,000 in 1980 bought you what $250 would buy you in 1970. Not surprisingly, over that period of time, the gold price increased 30-fold. Now, I'm not suggesting to you that the gold price increases 30-fold from here, because it's already increased 12-fold since the year 2000. But I believe, Chris, that it's likely that the gold price mirrors the decline in the purchasing power of the U.S. dollar.
RickRule notes that he has witnessed 3 major silver bull markets in his career, one delivering a 30-fold return and the other 2 providing 10-fold gains. Even a more modest 3-fold return can produce significant income, especially for patient investors. For Rule, the question isn't if another silver bull market will occur, but when. With high odds on the horizon, those who stay positioned stand to benefit meaningfully. Silver prices are rebounding strongly following April's pullback, and the metal has already gained 20% year-to-date. This momentum is underpinned by rising industrial demand, a trend that shows no signs of slowing. As the second half of the year unfolds, many believe silver's outperformance could accelerate. Peter Krauth, author of The Great Silver Bull and publisher of Silver Stock Investor, sees this as an opportunity for silver to begin catching up to gold on the gold-silver ratio. If gold continues its advance, silver could follow with even greater upside, especially given its historic tendency to outperform during late-stage precious metals rallies. On June 17th, silver rose to $37.4 per ounce, up 1.77% from the previous day's close. The move reflected growing bullish sentiment in a market already showing signs of tight supply, adding further conviction to the case for sustained gains. Let's get back to the interview.
But what I am seeing is, in a much more agnostic sense, the flow of funds into gold equities ETFs. That turned cautiously positive 15 weeks ago. And you're seeing the share price escalation in the best of the best senior golds, the Wheaton Precious, the Franco-Nevadas, the Agnico Eagles. I mean, you've seen a hell of a move in these things over the last 18 months. This is consistent with the performance of a gold bull market. It's precisely what you would expect at the point in time. So, yes, in an evangelical sense, the congregation is growing. And yes, they're enthusiastic. We are right where we expect to be. I remember you interviewing me some years ago about your listeners' frustration around the fact that the gold price was increasing, but the price of gold shares weren't. And I said to you at the time, turns out I was right for a change. I said, so one asset class, gold, has a buyer, foreign central banks. Foreign central banks don't buy gold shares. If you have one asset class where there are buyers, another one where there aren't, what you're seeing in the market is completely to be expected. When gold established its momentum, two things happened. It attracted some attention to the gold space, including from historic buyers. But as the increase in the gold price accelerated faster than the cost to produce gold did, the producer margins began to expand. And this brought people into the space. This is exactly what's happened in every precious metals bull market that we've seen. So what you're seeing today is completely to be expected. This is not something yet that is widely perceived. You and I look for mentions of gold or silver in the popular financial press. The truth is the average investor, including average institutional investor, doesn't know how to spell gold. Witness its market share, 0.5%. If gold, as I expect, I use gold as an aphorism for precious metals, if precious metals reverts to mean in terms of market share, if there is a fourfold increase in demand for the stuff, Chris, even someone with fairly lofty expectations like you as to the gold price appreciation, I think your wildest dreams of avarice may be satisfied. Silver's a late cycle mover. It has been in prior bull markets. And foreign central banks, despite the Russians saying that they might buy silver themselves, I would argue with a war going on, using what for money, but that's a different question. We've seen foreign central banks concentrate their purchase on gold, which is what they have always done. Gold needs to establish the momentum. When gold establishes the momentum, the narrative becomes popular. When the narrative becomes popular, gold outpaces silver. Chris, I don't know why it is, okay? I just know from having been on Earth a long time that it is. If you're asking me the question around the concept of a silver squeeze, here's the silver squeeze. There is more silver that trades in the futures market by far on a daily basis that is around for good delivery in a quarter. There are some days where the futures market trades 200 times the amount of silver available for good delivery. These things cash settle. It's important to know that. If they don't cash settle, what happens is that the market gets halted, and then the exchange forces a cash settlement at their price. But if you're looking for a place that a silver squeeze takes place, it's in the over-leveraged nature of the futures market. There are a lot of speculators who require immediate gratification. They carry about a 50-cent move in silver, and they actually believe that there is going to be a physical squeeze in silver that will force the institutions into the market in a big way. That won't happen. The futures exchanges operate in their own interest, in the interest of the dealers. If there is an ugly, ugly, ugly silver squeeze, which I think there could be, they will do what they do with the tin market. They will halt the market, and they will cash settle at a level they choose. You mean they'll screw their customers? Of course they will. That doesn't mean that there isn't a boatload of money to be made in the silver business. I've been around this business for a very long time. And a silver bull market is truly a wonderful thing to behold. But don't tell yourself, don't set an artificial timeline. Don't say, oh, for sure it has to happen by Thanksgiving. Why? The silver market doesn't care about your time preference at all. The silver market doesn't care about the stop date, the start date. They don't care. But in my experience, I've been through 3 silver bull markets. The first one was a 30 bagger, and the next 2 were each 10 baggers. Do I really care if it takes 2 years to get there, 3 years to get there? Put any discount you want in terms of the time value of money. Never mind a 10 bagger, a 3 bagger pays you a lot of rent. And I think it's a probability as opposed to a possibility that we get a silver bull market, a silver breakout.
As global monetary patterns shift and confidence in fiat currencies wanes, gold and silver are gaining renewed relevance, not as speculative investments, but as strategic reserves against economic uncertainty. With structural currency pressures mounting and historical analogies resurfacing, precious metals are increasingly viewed as tools for preserving purchasing power amid financial realignment. The latest surge in central bank acquisitions and silver's persistent industrial momentum both suggest that this revaluation phase may be far from over. Could the growing demand for tangible assets signal a more profound shift away from paper wealth toward a new era of financial security based on hard assets? Share your perspective in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.